GDP ratio towards the target anchor of 55%. So the ongoing fiscal consolidation in the medium term, again, should, as I said, should reduce debt vulnerabilities by reducing the fiscal deficit to 4.3 for this financial year 24-25. But over the medium term, the intention is to continue to narrow the fiscal deficit and increase the primary surplus, so that by 2028, 2029, the overall fiscal deficit will only be 2.8%. And by that time, we should have moved towards our target, our anchor target of the net present value of debt to GDP of 55%. On the banking sector, the total capital adequacy ratio remained above the statutory limit of 14.5%. In terms of the liquidity ratio, as of August, the ratio was 54.3%, and a slight increase from 53.5% in June. And again, this is compared to the statutory limit of 20%. The ratio of gross and non-performing loans to gross loans stood at 16.7% in August 2024, compared to 16.3% in June. And banks have continued to make adequate provisions for the NPLs. Finally, this is just to give you some data related to banking sector performance up to August of 2024. So thank you very much.
Thank you, and that was the Governor of the Central Bank of Kenya, who's also the Chair of the Monetary Policy Committee, Dr. Kamau Thuge. And as usual, we take questions. Just a reminder, if you want to send any questions, send them through Slido, slido.com. The hashtag is hashtag MPC1024. We shall begin with Charles Mwaniki from the Nation Media Group. So Charles asks, has the CBK been buying dollars from the markets given the $837 million rise in forex reserves over the last 5 weeks? Kefa Moirore, also from the Nation Media Group, asking, the 7th review of the IMF program remains pending. What are the remaining hurdles to clear this disbursement, and when can we expect this review to close? Final one from this batch, from Herald Allo from the Africa Report, asking, how confident are you that the current stable currency and US rate cuts will encourage significant inflows to Kenya and solve asset problems?
Let me start with Mr. Mwaniki on the issue of the CBK buying dollars, the forces of supply and demand. We do intervene when we see basically to moderate excessive fluctuations in the exchange rate. And it is true that we've had a significant increase in foreign exchange, both from banks but also remittances. So in order to moderate the fluctuations and volatility in the exchange rate, we have indeed been buying foreign exchange, and that is part of our role, and that's part of our business. And of course, the same can be said when the exchange rate, when there is need to intervene on the other side, when the exchange rate starts to weaken, then we would be able to intervene even on that side. But it's intervening to reduce volatility, not to affect the overall direction of the exchange rate that would reflect the fundamentals of the economy. So for this particular time, we do have quite a significant amount of dollars coming in, including also from tea as well. And so yes, we have been intervening somewhat in the foreign exchange market to build our reserves. And we do now believe that we have been able to strengthen our external buffer significantly. In the past, we have been able to build the international reserves of the central bank largely from either loans from the IMF, loans from the World Bank, etc., etc. But we are now building reserves not related to loans, but related to the excess foreign exchange that is actually coming into the economy. Kefa has asked a question about the 7th review and what are the remaining hurdles to clear this disbursement. So I think we have been having discussions with the IMF. The discussions now are really to combine the 7th review and the 8th review. We've made a lot of progress, significant progress. We are in the final stages of an agreement. The fiscal framework has been agreed. The fiscal deficit that I mentioned earlier of 4.3% of GDP has been agreed between the Treasury and the IMF. And so we have in our projections for the reserve build-up for the year as a whole, the one I mentioned, the $1.9 billion of accumulation, has assumed a disbursement from the IMF before the end of December. So I would say that discussions are progressing well, and we do expect that disbursements will be made before the end of the calendar year. Mr. Allo has asked how confident we are that the current stable currency and the US rate cuts will encourage significant inflows to Kenya and solve asset problems. I think suddenly the US has already cut their policy rate by 50 basis points last time. We had cut ours by 25 basis points last time. We have now to going ahead to reduce the policy rate by a further 75 basis points. It's also expected that the US is likely to make 2 further cuts perhaps in November and also in December. So our 75 basis points, I think, is in line with that, with what has already happened in the US, that the US has cut by 50 basis points, and is now expected to reduce their policy rate by 25 basis points in November and a further 25 basis points in December. I think the question perhaps would be whether the reduction in the policy rate will have any impact on our exchange rate, and the answer is no. As I've indicated, part of the strengthening of the exchange rate is actually coming from exports, agricultural exports. It's also coming from remittances, and there is a part that is obviously coming for to invest in the securities because of the high interest rates that we have. But I do believe that given that we have a stable exchange rate, that there is scope to reduce interest rates further without and still for them to be attractive enough for foreigners to still to be able to invest in our local security. So I don't see that this will have any negative impact on the incentives for investors to come and invest in securities.
The second part of the question where he's asking for an update on the IMF's review that's just been answered by the governor. Stella Swake from Standard Investment, who's asking, does the Central Bank of Kenya have any plans to set term limits for bank chief executive officers?
I think on the question from George Obulutsa, I think on the issue of the IMF review, I think I've already provided an answer to that. I think on the issue of the UAE, discussions have been held with Treasury, between Treasury and the UAE. It's at the moment, I think we are finalizing with the issues to do with the IMF. I know there is little scope for additional commercial financing, but these are discussions that the Treasury will continue to have with them, broadly speaking, with other external creditors to see how we can not only finance the budget deficit, but also reduce Treasury recourse to domestic borrowing. And that leads to the second question by Stella Swake on how does the CBK plan to lower these interest rates amid elevated borrowing needs. I think that is part of the solution is the reducing government recourse to domestic borrowing. As I said already, the budget, the supplementary budget that has been submitted to Parliament, we are reducing recourse by the Treasury to domestic. Mr. Hubling asked about setting term limits for bank CEOs. I think that issue has not been, we have not discussed that issue.
All right, thank you. The last set of questions, we begin with Brian Goge from the Standard newspaper. Brian is asking for clarity about the percentage of Kenya's foreign exchange reserves that is currently encumbered and what is the nature of those encumbrances. Back to Kefa Moirore from the Nation Media Group, the last question for today, which is that banks have bet on a sharper rate cut to nudge interest rates on facilities lower. Do you expect the borrowing costs and non-performing loans to ease just as quickly after the jumbo cut?
I think on Brian's question, to clarify the percentage of Kenya's foreign exchange reserves, which is encumbered, I think it's actually very small. I imagine it's, I think of our total reserves now of about 8.2 billion. I don't think more than $250 million is, or 600. Yeah, so I'm being told it's about 600. 600 is what is encumbered, but the figure I'm giving you is what as a gross usable reserve. So for you to get to the gross position, you would have to add that $600 million to what we have given you as the gross usable reserves. But the gross usable reserves are at 8.1, and by the end of the calendar year, we expect to reach about $8.6 billion. Yes, I think Kefa, on the, of course, the whole idea really of this sharp reduction in the CBR rate is to encourage the banks to lower their lending rates so that we can also reduce the NPLs and also encourage borrowing by the private sector from the banks. You've seen a huge deceleration in credit to the private sector, the 1.3%. This is fairly low, and we think that this is likely to have a negative impact on economic performance, and that's why we have decided on a fairly large reduction in the CBR. Of course, we are also, that reduction is also informed by the fact that inflation is well below the midpoint of our target range, and also we have had a significant increase in foreign exchange, and therefore we have stabilized our exchange rate. And in addition to that, that even with this reduction in the CBR, we still feel that will not result in any significant outflows of foreign exchange, and therefore there's no reason for the banks not to adjust down their lending rates so as to incentivize borrowers to take on more loans.
Thank you very much. And that brings us to the end of our post-MPC press briefing. As usual, these materials will all be available to you, especially what you've just seen with regard to the presentation, as well as the CBK MPC surveys. Those will all be posted on the usual place, that is our website, as well as our social media. You can engage with them in detail there. But as the governor said, it's expected that the MPC will meet again in December. So until then, do have yourselves a good afternoon.